The Harshad Mehta scam was really the trigger for, in a sense, everything that you're seeing today. I mean, I think SEBI was formed, at that point in time. Today, you can't imagine that a entity like SEBI didn't exist in the very early 90s. The Securities Act was formed, then Dematerialization happened, the markets opened up to foreign entities, so it became more. NSE was formed. I mean, BSE was basically a broker's club, and so therefore the intent was that we will form a separate entity, and then they moved to a completely electronic world.
One thing that kind of strikes me is just the progress we made in the last 30 years.
Amazing.
And 30 years it's a long time, but actually it's not that longer time as well, right? So we made some dramatic progress. But when you take a step back view, actually the progress we made is
tremendous. The way that we are doing business today will not exist 5 or 10 years from today. In the same manner that you no longer needed to go to a branch to update your passbook, I think the evolution in terms of AI and machine learning, etc., is going to completely disrupt the way we think about our business.
The Indian economy has gone through a tremendous transformation since 1992, when the country was first liberalized. The financial markets in the country have also evolved tremendously in this period. Our guest today is somebody whose career has been coterminous with this change. Joining us today is Rajiv Anand, who is the Deputy Managing Director at Axis Bank. Rajiv actually started his career in 1990, which was just before the liberalization, and has seen the country evolve and also financial markets evolve. Rajiv has spent time in bank treasuries, in mutual funds, within banks as in the retail banking side and in the corporate banking side, and he's overlooked many other functions. So there is rarely someone we find who has such a plethora of experience across areas who can share with us the story of the last 30 years. Rajiv, welcome to the show.
Thank you for having me, Samir.
For our audiences, after a stellar 16-year career with the Axis Group, Rajiv is retiring later this week. And so it's also an opportunity for us to hear from him, his experiences, and learn from those as well. So Rajiv, thanks for joining. And let me start at the very beginning when you joined. It would be helpful to just understand the state of the Indian financial markets at that point in time. I have some data that I'll share just before you start. First is, in that time period, Sensex was at about 1,000. The overall banking sector advances, which is total loans given by all banks put together in India, was about 1.3 trillion rupees. So that is kind of then.
Many small mutual funds are bigger than that today.
In fact, the number that I was looking at was, if you look at Axis Bank today, Axis Bank is 10 trillion rupees in terms of advance. So just one bank is approximately 8x what the entire market was then. At that time, obviously, there were there were some private sector banks, but they were very, very small. And the big ones, which is the big 4 banks, didn't even exist at that point in time. So obviously, the market has seen like a tremendous change. But it would be great to hear from you how you found the markets when you joined.
So let me take you one step back. I qualified as a chartered accountant in 1990, and I got a rank in the final exam. So what typically happens is that most companies get a copy of the rank holders and they call you for an interview, etc. And I got a job with HSBC. And while I did get jobs with some of the other entities like Hindustan Lever, I chose HSBC for only one reason. They were sending me to Hong Kong for 6 months. Levers were sending me to a village called Ita for 6 months. Guess what I chose? So I think some of these are, what happens to your life is a function of the choices that you make, and some work out, some don't. Once I finished the 6 months in Hong Kong, I got posted to Treasury in Bombay. So the first day you walk in, there were about 10-12 people in the room. They have a complex web of phones, of how you needed to figure out how to pick up the phone in the dealing room. There were these green screens which gave you updates on. In those days, the only thing that we used to get was updates on dollar rupee, updates on cable, which is GBP, dollar, and stuff like that. And so therefore, that was really what financial markets were all about. Everything was on the phone, and I got posted on to the money market desk. So my first job was to ensure that we were maintaining CRR on a daily basis. Typically, if I remember right, HSBC was always short rupees, so we were always borrowing in the call money market. Everything that we maintained was on a sheet of paper.
Right.
Really, the entire bank's CRR was run on a sheet of paper. Remember, this is the days before even Excel, and so that was that was where I really started. What is very interesting is the money desk was also the fixed income desk as well, and there was actually a very active fixed income market in India at that point in time. It was a market which traded on a daily basis. Plus, it had a ready forward market. Plus, it had a futures market, meaning that you could buy today for delivery 7 days later. Stuff like that. And all this was around an instrument called bank receipts, or BRs, as we now know. So the market was, in that sense, from a sophistication perspective, was pretty good. Similarly, the equity markets had Badla, and you know how Badla works, and so therefore, in that sense, the sophistication of the market was pretty good, and so therefore, you could have positions in the spot market, you could have positions in the futures market, you could be short because you only needed to deliver 7 days later, etc. And so therefore, that was really what the market was all about. Dominated by the foreign banks. I mean, like you mentioned, private banks didn't exist at that point in time. Most of the public sector banks, used to be buy and hold players. So very rarely did you see any of them playing. The insurance companies weren't there, mutual funds weren't there. So therefore, it was basically the foreign banks and banks like Andhra Bank and Canara Bank who used to be fairly active. So that was what the markets were all about. Reasonably vibrant. There was, I think the big thing that as I look back, the big thing that I can now think of is information asymmetry. So there was no Reuters screens or TV or CNBC which gave you instant information, or Twitter which gave you instant information. Everything was phone driven. Everything was physically settled. And then like you said, 1992 happened. I'm actually like you rightly said, a child of liberalization. I think as soon as I joined, the first thing that happened was the whole liberalization, which was basically around the fact that the first stage was, if I remember right, the rupee was around 19 rupees at that point in time. And then in a two-stage, rupee went from 19 to 31, 37, and where it got stuck for almost 2-3 years. And that was really the start of the evolution of markets, evolution of I still remember the time when we got one color computer screen in office with a mouse, and that gave you the Reuters screen as we see it today. It was special, only the treasurer could use it, and we had to take permission to use it, etc. But over a period of, and we had one machine for about the 15 of us. And then that's really when things began to sort of move forward. We started to get more players into the markets. FIIs started to come in 1994. Then private banks came in 98, 99, etc. They're also a function of the fact that people, there were more job opportunities. You could move from fixed income to equities. Equity research started to play out, and nobody knew equity research before, let's say, 1998 or so. The big player at that point in time used to be Unit Trust of India, and that's really how the markets evolved in the early 90s. There's an interesting instrument that I should certainly talk about. US 64 was very actively traded from an institutional perspective. Yes, I'm sure your father, your grandfather must have been holding units.
US 64 is a scheme of Unit Trust of India.
Was a
Was a scheme, yeah.
Was the first mutual fund in India, so to speak.
Right.
And that even institutional investors used to hold in large quantities. Why did we hold? Because we used to make a call on how much of dividend that they would pay on a monthly basis, and that dividend used to be tax free, etc. And so therefore, there used to be a play around that and how much it will trade, ex dividend and stuff like that. So there was a market, institutional market around that, and banks were quite active within that space. And of course, all of us know that US 64 had its own problems, and then it actually collapsed. So therefore, you can see that it was a market which was reasonably active with not so many players as we see today. There was information asymmetry, and everything was physical.
Right. So Rajiv, as we go through this, I'll bring some quote unquote pivotal moments where many shifts happened. But before we go to the first one, essentially at that point in time, if we think of markets, so first everything was physically settled, including like if you were trading on the stock markets, the share certificate was had to be physically kind of settled. Settlement time was 7 days, which means if you bought or sold a share today, you have to pay after 7 days, and you get the share certificate after 7 days. Everything happened on calls, as you said. Even banking operations were all paper driven, because even before Excel, as you said, or even the first set of core banking systems and the like, and mutual funds were just coming into the market and so on and so forth. So in 30 years, just kind of it has moved very dramatically. Like, it is unthinkable today that a treasury runs its CRR on a piece of paper. It is, kind of just completely unthinkable. Or that you have to, I don't think people today know that there is something called a share certificate. Forget.
So let me give you, let me make this whole story a bit real.
Yeah.
That there was one day when, so ultimately the responsibility of maintaining CRR for the bank, was with our desk.
Right.
Right. Nobody really, other than that, nobody really cared. Nobody cared about CRR from that perspective in the rest of the bank. And so therefore, one day, let us say we were, like I said, we were borrowers. We borrowed, very last minute because some outflow must have happened or whatever it is. And then my back office said, it's too late. So that the check had to come from, let us say, State Bank of India. A bank, RBI check came from say State Bank of India, and it needed to be sent to RBI for clearing, because you then need that credit for the day for you to ensure that you're maintaining your CRR for the day. The back office, I think, let's say it was 2:45. The back office guy said, there is no way we can do it. It's too late, etc. I have actually got into a taxi with that 100 crore check and deposited it in an RBI, because finally it is my responsibility to get it done. Similarly, even on the bond side, so you spoke about the fact that if you bought shares, you had to pay for it. The settlement cycle was 1 week. But what happens, when you actually buy shares, then those physical shares go to the company, and then the company has to transfer the shares, back into your name. That whole process could potentially take, anything between 1 to 3 months.
Right.
So therefore, you have the shares, you've sent it for, share transfer. It goes to the company, and then company will send it back. All this was, by post. But so therefore, even then, even that situation, whether it was shares or bonds, it was very similar situation. I mean, I remember IPCL bonds used to be fairly actively traded, but those bonds used to have to go to Baroda every time you transacted them, and then you were doing some jugaad, some trying to figure out how soon these will come, so that you are in a position to be able to sell it, because otherwise how do you book profits or whatever it is. So the process of trading shares or debentures, as the case may be, was quite complex in those days, because it was all relying on physical. It had to, the process, you sent it by post to the company. The company would register the transfer, send it back by post, and only once you got the physicals back could you actually sell it again. So the the process was quite cumbersome, and so therefore, as the mutual fund industry started to sort of build out, as FIs start to come in, we started to get custodians as well, but the process was exactly the same. And so therefore, custodians like Deutsche, etc., used to have this massive vaults, right, for storing these share certificates, and there's to be a share transfer, green colored share transfer form, and each of those needed to be signed off. So people like HSBC and Deutsche actually recruited retired people who their only job through the day was to sign those share transfer forms. So if you bought, let us say, 500,000 shares of Reliance, typically each share certificate was 50 or 100 shares. So you can multiply 50 or 100 shares multiplied by 1 million shares or whatever a mutual fund or an FI bought. Each of those then needed to be signed off and then sent to sent to the company, etc. So therefore, they used to have these massive vaults. I remember Deutsche used to have one really literally down the road from where we are today. And then suddenly one day everything changed. Everything was dematerialized, which means that all this transfer that we've just been speaking about was electronic and pretty much instantaneous. And so therefore, all these people who used to have these massive vaults, I'm not sure what they've done with it. It's probably become a giant size fish pond or something like that, because the vaults that I was speaking about was like the ones with the thick fireproof, safe kind of structures, and literally overnight the world completely changed in the Indian context. And I think as they say, nothing happens for decades and everything happens overnight, is a bit is something that we can easily define what's happened in financial services over the last 25 or 30 years.
No, absolutely. There are many such events, and we'll go through all of them. But this dematerialization was a massive turning point.
Absolutely.
Because, as an example, today, if you want to buy or sell, you just go on your mobile app and click a button.
Correct.
None of this would have been possible had that infrastructure, which is a centralized, kind of entity, which is doing this share transfer, etc., on our behalf, was not created back in the 90s. And I think some of the stuff that has been created in financial services in India in particular is quite visionary from that perspective. Kind of at that point in time, I'm not sure people could have forecast that 30 years down the line, people will be trading on mobile apps and so on and so forth. But they still set up that infrastructure, which is today helping us. So Rajiv, let's come to one super pivotal moment, which is this entire Harshad Mehta scam. And you were then obviously in the
bang in the middle.
Bang in the middle. You spoke about bank receipts, which are now, I think, popular in the masses thanks to the series. But just talk to us about what happened, how you went through it, and some interesting anecdotes from them.
So markets were on fire. Harshad Mehta was quite the star across in the media. What he was doing in to the markets, but we never saw the presence of Harshad in the money and bond markets until the problems really began. And then it was really it's a bit like a Ponzi scheme, the BR, right? I mean, at the end of the day, you are really relying on the fact that once if I finally ask you for settlement, you should be able to deliver deliver the underlying. I think once that virtuous circle broke, that is when people began to realize that it's not just Harshad, but there were multiple entities within the broking community, within the banking community, where whether implicitly or explicitly in the know of what was actually happening, and then the edifice at that point in time began to crumble, and then you saw all the newspaper headlines and markets crashed, and then it becomes a vicious cycle, right? Because because markets are falling, you got to, you got to settle at the end of 7 days. What you bought is worth 50% less or 40% less. You don't have the money to pay for the stock, etc., etc. So very quickly, what we saw was that once again, RBI played the savior. They came in at that point in time. Um, if I remember right, I think the fixed income markets, I mean the government securities market, pretty much froze, and there was very little activity. There was only activity in the money markets, just for day to day settlements, etc. Some of the banks who were sort of deeply impacted as a result of this, I mean, like Greenlays and Stanchart, they had large forensic teams which were trying to unravel all these transactions, and it was quite complex. Then we got to know about some of the PMS, transactions that PSUs had done. The government formed a joint parliamentary committee, which and then you saw bankers being presented in front of the JPC, and then it just I think the Harshad Mehta scam was really the trigger for, in a sense, everything that you're seeing today. I mean, I think SEBI was formed, at that point in time. Today, you can't imagine that a entity like SEBI didn't exist in the very early 90s, right? And so therefore, SEBI was formed. Post that, the Securities Act was formed. Then dematerialization happened. The markets opened up to foreign entities, so it became more
NSE
professional.
was
The NSE was formed. I mean, BSE was basically a brokers club, and so therefore the intent was that we will form a separate entity. Then the open outcry, went away, and then we moved to a completely electronic world. And I must mention this: you mentioned the fact that today you can buy a share of 50 shares or 10,000 shares, whatever it is, on the mobile, and what your price is to the last naya paisa. I mean, let us say you bought Axis Bank at 1100 rupees. You bought it at 1100.02 or whatever the number is. In those days, what most people in South Bombay would do is before they, I mean, if you took a train home every day, you would buy what is called a bhav copy, which gave you the range of every stock that is traded on that bhav copy. And so therefore you knew that Axis Bank, I mean, I'm just making this up, or Hindustan Lever traded in this certain range during the day, and that was the only way that you got to know what stock prices were. I mean, today you've got stock prices on so many channels, so many platforms on a real time basis. There you didn't know what the market did till you saw the bhav copy, or the next morning. Economic Times, or even Times of India, used to have one page full of stock prices. And so therefore you typically, if you wanted to reevaluate your portfolio, you would look at that on a daily basis to figure out whether your portfolio has gone up or down. So I think from there, like I mentioned, SEBI, dematerialization, opening of the markets to foreign entities, the market itself becoming more professional in terms of relying on research and so on and so forth. And then of course the mutual fund, we spoke about US 64. But the other very interesting one was Morgan Stanley. Morgan Stanley was like any other open-ended mutual fund. It was the first mutual fund, but because it was Morgan Stanley, it actually got oversubscribed. I mean, I used to work in HSBC at that point in time,
right.
Which is at Fountain on MG Road. There were lines around with people standing with forms to put money into Morgan Stanley mutual fund, because it was a unique concept at that point in time. And then of course it for a brief period it was a large mutual fund, but I think just the size of that mutual fund, in those days, I think it was about 2,000 odd crores. In those days, the sheer size of that fund really meant that it underperformed for a fair bit of time. And then of course Morgan Stanley sold their mutual fund after a point in time. But that was really the beginning of the mutual fund industry.
So 90 you joined, 92 liberalization, kind of the stock market issue followed by a series of reforms, which then laid a platform for the future. In the year 2000, you shifted from banking to mutual funds. So, what drove that, and just your experience in setting the mutual fund up and how that worked?
We spoke about Morgan Stanley, and at that point in time, I had joined Angel Greenleys in 1997. I was on the ALM desk, trading money and fixed income. And then Angel Greenleys decided to set up a mutual fund, and so they were looking for first a CEO. I think they already identified a CEO, and then they were looking for a fund manager fixed income. I just felt that this looked like an interesting opportunity. I don't think more than 3 people applied for the job at that point in time.
Okay.
Because I mean, in the mutual fund industry, nobody really
Was
cared
not
about
known.
that industry.
Yeah.
It was too small. I mean, the glamorous job was to be a trader in a foreign bank and make big bonuses. And here I was actually moving in the opposite direction. So I just felt that we were looking to set up something new, and I said, "Chalo, let's see how this works out." And that's really why I put my hand up to become a fixed income fund manager in what was then called ANZ Greenleys Mutual Fund. And then Greenleys got sold to Stanchart. We were in a bit of a hiatus at that point in time. We did not know whether Stanchart wanted to run a mutual fund or not. And during that period, I actually worked with lawyers doing the memorandum and articles of association of the mutual fund, going to SEBI, getting clearances, and a fantastic experience. I mean, although I must say that we ran, and then I also honed my skills I didn't know anything about being a fund manager, so I honed my skills running, dummy portfolios, marking it to market on a daily basis, creating an NAV for that, so that as soon as we were ready to launch the mutual fund, we'll be ready to manage money as well. Just, I think it's important to know, in those days, the benchmark 10 years used to be 1305. The coupons used to be 1305. Then it became 12.5. So the point I'm making is, in a world where today, if the 10-year goes very much beyond 7.5%, I mean, everybody sort of panics. It just gives you a perspective on how inflation expectations in this country have got reset, and therefore we are in a structurally lower interest rate regime. I mean, yes, relative to 7, we want to be at 6, or if we are 6, we want to be at 5. But fundamentally, we moved from the 13s and 14s into an economy which is somewhere between, a 10-year bond typically trades somewhere between 6 to 8% over the last 10 to 15 years. Has been in that range. So therefore, all the structural reforms that have happened in the market, all the reforms that have happened in the economy, have also ensured that structurally interest rates in this country have significantly lower, which in turn has, I'm sure, helped economic activity and so on and so forth.
It's a very critical point, which is, if the GSEC coupon is at 1305, then the home loan is likely at 16 or
Correct.
17.
Correct.
So the most secured asset, which is a home loan, coming in at 16%, versus today it's at between 8 and 10,
yeah.
right? At 10, people start howling,
Yeah.
right? So 8 and 9
Yeah.
is, I would say, the sweet spot for a home loan. And so just this, basically home loan rates have approximately halved. And just halving of that home loan has enabled so many more people to take the loan, because otherwise 16% is just not affordable.
Absolutely.
And the market itself kind of hence expands quite dramatically, which is, we'll cover this in subsequently, Rajiv, which is, in the 90s, when you were obviously in the treasury side and ALM and so on and so forth, but retail banking broadly did not exist. And anyway, we'll come to this when we come to your banking stint. But let's continue on your mutual fund experience and how that panned out, and any anecdotes you want to share from there.
I think the initial part of much of the Indian mutual fund industry at that point in time was the bitter experience of US 64, where everybody and his grandfather had money there, and then subsequently blew up. However, then the government had to step in and issue bonds to unit holders, which got repaid. And actually, it's quite interesting that what they did with US 64 was they paid off the unit holders. The unit holders got, I think, if I remember right, a 6% bond repayable over the next 5 or 10 years. And the government formed what is called the Special Undertaking of UTI, and all the assets of the erstwhile UTI sat there. Incidentally, one of the shares that were held there was UTI Bank, or what our employer Axis Bank, including L&T and ITC. Actually, the government, just by the fact that they didn't need to sell in distress and they're holding it for a long period of time, were one of the significant beneficiaries of sort of long-term investing, and the fact that the markets and the economy did really well. One of the big beneficiaries also has been the government through the Sooty scheme.
Yeah. In fact, Sooty held Axis Bank shares till about 2020 or 21, I think.
That's correct.
And so if you just think about that, in that time, I think at that time, the stock used to trade at 10, 15 rupees. And then it has split as well. And now it is at $1,000.
Correct. So effectively, it's 5,000 rupees.
5,000 rupees. Yeah.
So you had the bitter experience of US 64. Then you had Morgan Stanley, where I don't know whether Morgan Stanley did anything wrong, but I think the market expectations out of that scheme were perhaps incorrect, and so therefore that was really the context around which the mutual fund industry was being set up. By and large, most people believe mutual fund is equal to equities, at that point in time. So therefore, we were the only mutual fund at that point in time which didn't do equities. So we were a pure fixed income fund house, and to that extent gave us a unique positioning. So therefore, there was a lot of learning that we had to do, but more importantly, a lot of teaching that we had to do to distributors, to investors, in terms of what these schemes do, how do you get a return, how are they superior to fixed deposits, what kind of instruments will we invest in, etc., etc. And I think that was an amazing experience. It also was my first experience, talking to retail investors. So therefore, as a fund manager, your job was to manage money, but also go and meet distributors and their clients, to explain to them on what exactly did you do with the money, etc. And so that was a really fascinating experience, where you Mother Teresa's missionaries of charity were investors with us in our scheme. And I remember meeting them, and they said, please ensure that we don't lose money, because this is money of God and stuff like that. So it was quite interesting, meeting many of these clients. Relative to fixed deposits, obviously, the obvious question is, what return will I get? I mean, it was the obvious question that you always got, and you could never say. You said, oh, if everything remains the same, then your returns will be between so and so, so and so. But then customers used to say, why bother with all this if I can get a predictable return out of fixed deposits? Mercifully, what happened was that it was really around 2000 when interest rates came off quite sharply, and returns from bond funds, etc., were in high double digits, and so therefore suddenly fixed income became quite fashionable. Equities were doing nothing in particular, at least up to 2004, 2005, and so therefore fixed income mutual funds grew quite strongly, and in that environment, fixed income fund managers in a sense thrived. And people like Nilesh Shah, etc., we were all contemporaries. We were all managing fixed income funds at that point in time. So therefore, I think what is quite satisfying is, did we ever think that the mutual fund industry would be where it is today? Absolutely not. But I think the fact that we were part of the team that laid the foundation to this, to the mutual fund industry as it is today, is very, very satisfying.
Fantastic, Rajiv. So Rajiv, the next kind of pivotal one is the financial crisis. So India had this, how should I say, glory days, and actually the world had like a pretty fantastic economic and financial outcomes till about 2007, maybe in India till 2008, 9. And then there was this major global crisis, and India was not kind of left unscathed. Any learnings from there? Anything you saw? Any anecdotes?
Yeah, I often say that the two big, I've been on the wrong side of two big crises over the last, let's say, 20 years. I was actually running money in Standard Chartered Mutual Fund at that in 2008, and it was an extremely stressful period. You had to, every day you had to meet redemptions. You did not know where the liquidity came. You had no idea on how the markets will play out the next day. Literally the next day, forget about having a long term view. You were not sure of whether you were going to get any inflows because people were very, very risk averse at that point in time. And the other point was I was running the retail bank for Axis Bank when demonetization happened, and I'm sure we'll talk a little bit about that as well. So I've often said that the two big issues that have played out between 2000, I said 2008 and today, I've been on the wrong side of that trade, at least from a management perspective. 2008 was what was interesting at that point in time. What came out very clearly is it was less a equity crisis. Rather, the crisis really played out from the fixed income side. You saw defaults, you saw liquidity disappear, and so therefore, bond deals just took off because of the fact that there was that lack of liquidity. RBI was trying to manage the rupee, tighten liquidity, etc. It was inevitable that a financial crisis would play out in India as well, and so therefore you saw pressure on NBFCs. You saw pressure on mutual funds, not so much on the banking system. But it was really at that point in time, once again, RBI had to step in, because of the fact that the contagion impact because at that point in time, by 2008, the mutual fund industry had become reasonably big. And so therefore the contagion impact from mutual funds and NBFCs could potentially have been quite significant, but they opened liquidity windows. They encouraged banks to lend collateralized lending to NBFCs and mutual funds, and then over a period of time, that crisis dissipated. But I think the key there is liability management, and I think if you look at whether it was in 2008 or even in the NBFC crisis in 97, 98, much of the problems really have come from the liability side and not so much from the asset side, which is why I think it is any entities which are wholesale funded. I think they certainly need to be careful, because perhaps they need to temper their growth relative to the growth of the underlying wholesale market liquidity, for them to be able to manage their liquidity, or look to diversify their liability profiles, not just into India, but even within India, from banks, mutual funds, retail, as also look to raise money perhaps a little more expensive at some times, even from overseas, to be able to diversify this risk away.
Right. This is also around the time, Rajiv, when you joined Axis Group, 2009, which I guess the crisis is playing out maybe towards the fag end.
It was a fantastic time to recruit.
Right.
I think there were mutual funds who wanted to open but shut down. Goldman Sachs wanted to open a mutual fund; they quickly shut down. People were downsizing. So therefore, from that perspective, it is a fantastic time to build a team. And so therefore, I was really fortunate to have been able to build a team at that point in time, for two reasons. One is people were available, people were amenable to move, and people were I'm able to move at a reasonable price. So therefore, and I think we built a great team, which is really the foundation for what is Axis Mutual Fund today, and many of those guys that we recruited at that point in time, stayed the course with the fund for anything between 5 to 10 years.
Fantastic. Let's now move into the banking space. I think you joined the Axis Retail, Axis Bank, and within bank the retail banking franchise. You ran the branch network. So we'll come to that, Rajiv. But I just want to kind of reverse, go back a little bit, which is we made this point that before 2000 there was not really so much of like as in ATMs started to come in India. I think around that time, maybe 98. 2000 is when ATMs started to come in, and it is the kind of the private sector banks starting to focus and set out the retail banking as a business line. So just talk a little bit about this kind of how you saw banking in the early part of your career and how it transformed by the time you had joined.
So if you looked at the early part of my career, I really didn't care about what happened in the rest of the bank. I mean,
right.
I was always inside a dealing room, and what worried me more was whether I had enough liquidity for tomorrow's CRR or what happened to the positions that I was running. But I think if you look at it, the fact that markets evolved was because of because infrastructure got constructed during the 90s.
Right.
SEBI, Dematerialization, NSE, and so on and so forth, and that created the pathway for long-term growth of the capital markets in this country. In the same manner, I think it was in the early 2000s. Much of the business that banks ran, including Axis Bank, we were 80% wholesale, 20% retail, and really that the pivot really came sometime in, let's say, between 2007-8, just post the crisis, and I think, just to use the same capital markets example, it was really because of the fact that you saw the evolution of Aadhaar, mobiles, data, credit bureaus, which is really, as those got constructed, banks got more and more confident about the fact that you could actually lend to retail in a granular fashion. Risk was, much more well contained, and you could potentially be a very profitable entity, from the retail side. And that's really, to my mind, started only in 2010, 11. Maybe they may have been one or two success stories. HDFC Bank, comes to mind, where they have done a pretty good job on retail even before this. But I think fundamentally, as an industry, it started to evolve in really 12, 13.
Right. And the evolution also very stark, right? Like you're moving from a time when to withdraw money you had to go to your bank branch. Right.
You had to you had to take 1 day's leave for what was called bank work.
Right.
In the old days, which means that you took a day's leave from work to go to the branch to update your passbook, to get a new checkbook. There was no concept of cross selling or any such thing, but this more mundane stuff is what you did, and for that, you had to actually take a day's leave. From where we are today to everything that you have built on the digital side, when you can transfer money on a Sunday evening, watching Netflix, or pay or bills on Sunday evenings sitting at home, is a mind-blowing change. And I think perhaps somewhat underappreciated. And I think what that also teaches you is that customer expectations are constantly changing. So for a guy who used to take a day's leave to where we are today, it should be like godsend, right? But customer expectations keep changing, saying that, hey, your mobile app is too slow, which means that instead of spending 15 seconds, he's spending 30 seconds on your mobile app, and therefore he's cribbing. So I think expectations are constantly changing, and banks like us, we need to keep up with technology and customer expectations.
Yeah. I remember when I was much younger, obviously. So one of my jobs used to be to take all passbooks in the house and also the neighbors and go to the branch nearby and get them updated. So and then like the next week, the neighbor's kid would go and so on and so forth. So yeah, so you come a wrong way from that. So Rajiv, now coming to the Axis Bank retail franchise, I think 2013 is when you started kind of look at that. Obviously, from there also there has been in fact, this was, I would say, in some ways a golden period for retail banking, as you mentioned.
Absolutely.
So just talk us through a few of the things that you saw that changed and you kind of.
So let me, I think, let me talk about the, Axis Bank experience. So up to that point, I think Axis always had a fantastic liability franchise. I think we were one of the early, pioneers of using ATMs in the early 2000s to be able to widen the branch catchment area. Today the ATM may not be that relevant, but at that point in time, the fact that you did not have to go to the branch, but you could quickly withdraw money, from an ATM, was quite radical. They were one of the first banks to be able to, who also started to segment. Priority banking, as we know today, was one of the launches that that Axis Bank had in the early 2000s. Work that they did for senior citizens, and so therefore, Axis Bank was always had a very strong liability franchise in it. And as we started to think about, okay, this is a great franchise, but what can we do more? And the whole concept of cross selling started to evolve. In that context, the bank decided to set up a mutual fund, branded Axis Mutual Fund, to be able to sell mutual fund products. It tied up with what was then Max New York Life to sell insurance products, and started to build out a retail asset business to start with secured products in certain areas, and then slowly but steadily widen to unsecured and sell across the entire branch network. Data showed you that the more products that customers had, the better were their liability balances with us. And so therefore, to be able to do that, you built out a team, you built out a data analytics team, you built out a team of a strong retail asset professionals, um, and then sold to your existing customer base, the base that you know the best, right? And then you found the benefits of that. You found the benefits of the fact that you're selling to existing customers. You found that the liability franchise became much healthier as well. And I during that period, I always used to tell analysts and investors used to come and meet us that look at all the fee incomes that we are generating, from this franchise, and all the loan products that we are selling to this franchise should mean that it is an engaged, active, healthy franchise that we are building, and that is, in a sense, the way that we thought about the business as well. Continue to gain market share on the liability side, continue to open new bank accounts, open new branches across the system, and then be able to cross sell multiple products so that the stickiness really improves. We were inspired by Wells Fargo's 8 is great concept, that every customer should have 8 products. Incidentally, the other day I was reading, why 8, why not 6, why not 9? Apparently the CEO at that point in time came up with 8 is great because it just sounded good, right? I think the bank was quite inspired by what Wells Fargo did at that point in time, from a retail bank cross sell perspective. The big shift that we also made in 2013-14 was we had a decent internet banking, and that is what most people used, but it was just the beginning of mobiles. Forget about mobile banking, but not very many people had smartphones, and the bet you made was that smartphones will become cheaper, more people will have smartphones, and so therefore, and then that's when the smart Apple phones came up, and apps started to develop, and that's when we launched our own first app, which is what you run today. We built it bottom up. Most other banks looked at mobile banking, I mean, I don't think everybody was very convinced that people will do mobile banking.
Right.
That it's too unsafe. People will want to use a computer and internet banking. So most people thought of their mobile banking as a smaller version of internet banking, and so therefore built it accordingly. But we actually built it bottom up. We used a company called Tagit, who we still continue to use to build the base. We used some designers out of Australia to do the UI UX. What do we know about UI UX, right? As bankers, I mean, the whole concept was alien to us, and that's really the beginning of mobile banking as we know it today. And that, I think, has been the evolution of mobile banking. I'm not saying digital banking, but mobile banking, I think, has been that big seminal shift that has happened on retail, because stage one was banks, particularly private banks, were getting more and more efficient in terms of using data. Banks that were able to use that data and convert that into intuition on customers were obviously benefiting. They were using that for underwriting, and therefore that was getting better and better. But people who were able to deliver that in a simple manner, particularly through the mobile, were actually winning in the marketplace as well. And so therefore that was really the beginning of pre-approved personal loans, where a customer could at a click of a button get a personal loan with the amount being credited to his account in a matter of seconds was mind-boggling. And the fact that banks like us got that successful was I think an amazing story.
Yeah, there are two other themes or stories, if I may. The first one is retail lending, and kind of it's remarkable. The last retail lending crisis in India, the real kind of a big one, was in 2009,
Correct.
ish. And so we've had now 16 years. Right now, for the last couple of quarters, unsecured lending is high, but frankly, it's not
From the low, it's a
from
high.
the low. It's a high, but it's not killing anybody.
Correct.
The real crisis where companies got shut and massive layoffs happened, and so those in 2009. And so we've had 16 years of very low contained consumer credit, and also we've had almost 10 years where consumer credit grew leaps and bounds. So helpful to get kind of your perspective on what.
Yeah. So, Samir, it was quite interesting that for years, unsecured risk was actually playing out better than secured risk.
Yep.
And when I used to meet investors and analysts, I used to say, this cannot sustain. But year after year, I was wrong on this. I mean, it just got better and better. But I think one also has to realize that we were coming off a low base. I think household leverage was significantly lower if you compare it to peer countries, and certainly relative to China. But I think that situation has now changed. We are now, if you look at the three buckets of savings that we have, households, government, and corporate, it's actually quite interesting that corporate leverage is probably, they're so delevered. We've never seen them like this, at least in the last decade. Government, the fiscal deficit is actually in much better shape than we've seen in a very, very long time.
Yeah.
But the one place where leverage has actually gone up quite significantly is in Indian households. And so therefore, as you think about household retail risk, this is something that why all banks will certainly need to consider as we go forward.
Right. Having said, just kind of looking at the history, kind of a couple of things which have helped. One, again, going back to the theme of this setting up infrastructure. One is the bureau infrastructure and the kind of regulatory backing that has got, which did not exist actually prior to 2007. It just did not exist.
And it took time as well. I mean, in the sense of, it took time for people to realize that if you defaulted, it showed up in the on the bureau. If it showed up on the bureau, your ability to get another loan has become very difficult. This whole thesis, took time for people to understand.
Right.
And then once people understood, then obviously credit behavior certainly improved.
Right. So there is that infrastructure. The second is broadly digital, which is, this kind of Aadhaar type of stuff, which helped in the KYC, but also just digitization of processes, which just made processes, like I'm not talking of digital, but just, instead of kind of filling a pen and paper, somebody comes and takes data on a tab, and then it electronically goes to some central center, and that center kind of does the processing. Just even that, and obviously subsequently the digital, which is the customer does two things on the app and the money is in their account. All of these have come together to kind of deliver this growth. So again, another example of how infrastructure build, which happens at some point in time, then subsequently kind of results in great growth.
I completely agree that everything that you mentioned is really the primary reason why we have had a decade of growth,
right,
on retail assets, through the banking system, through the NBFCs. That is the primary driver, and I'm now beginning to see an equivalent play on the MSME side as well.
Right.
I mean, we are beginning to see Udyam certification, more digital transactions, GST,
Yep.
are all helping banks understand smaller merchants much better, and therefore to be able to lend to them. So therefore, I am quite bullish in terms of the fact that the infrastructure that's gotten built on for MSMEs today will drive growth in that sector over the next decade.
Right. The second theme, Rajiv, and I want to hear from you on this because you were one of the early proponents, is UPI, which just, it came out of nowhere and it is today like this mammoth, right? So yeah, talk us through UPI.
So, some of your predecessors on the digital banking side came to me one day saying, hey, there is this concept called UPI, we should sign up for it. And then, so they basically explained to me, what it is. It didn't exist. I mean, it was just beginning to get built out. And I said, it sounds interesting. We should be, early to this game. If it takes off, then it should be, we will be at the, forefront, so to speak. In my head, the way I was thinking about it is, till that point in time, even in digital, it was still a bit cumbersome to be able to transfer money. I mean, you had to create a beneficiary,
yes,
put in the bank account number, put in the IFSC code, etc., and then only then could you transfer money to people. Here, you could actually you could transfer money to was as simple as creating and sending an email, because you had a handle for every person. So therefore, we said, hey, let's sign up for this. Many banks signed up, early. The two banks which held back at that point in time were HDFC and SBI. And to some degree, UPI, the launch actually got delayed because these two entities, didn't sign up at that point in time, and ultimately, they did sign up. But I think I think the beauty of UPI is how democratized it has become. Even my maid will now say that हमको UPI कर दो, and so therefore to that extent, what the country has been able to achieve through UPI is truly phenomenal. Yes, we've had issues. I was in the NPCI board at that point in time, and one of the things that was happening early was failure rates were very high. And that was also because of the fact that many of the public sector banks, their infrastructure was not good enough to take on the volumes that were getting built. And so therefore, as a board member there, I kept pushing NPCI, saying that we need to get these failure rates down dramatically, because otherwise, customers will lose faith in UPI, and to get them back then will become very difficult. But I must commend NPCI. They really pushed, particularly the public sector banks, because the entire system needed to work in consonance for UPI to to work in the seamless manner that it is today. And I think it is important to call out the work that NPCI did during this time to ensure that in the early phase, things like failure rates, etc., kept coming down.
Yep. And I think, I kind of, in various forums, this keeps coming up, and I keep telling folks that UPI has actually spoilt us, because now the expectation from any public infrastructure is that it will do 1 billion transactions a month, right? And doesn't it kind of takes its time? And by it's not like the UPI was a nice smooth sailing story throughout. It had its challenges in the beginning, and as you said, failure rates were high, and lots of things had to come together, and lots of folks had to kind of come together for it to get to the level that that it did get to. Great. So Rajiv, we now move to the next crisis, and or actually two crises. The first one in your retail tenure, which is the demonetization. And obviously it was, I don't think we remember it that much now, but it was for bankers, it was a very trying time. And you were obviously running the retail bank at that point in time. So just talk us through what happened and what you learned and so on and so forth.
Usually, my wife and I don't go for movies on weekdays, but I remember on that evening we were watching Benedict Cumberbatch movie. I can't remember which one, but and then either somebody messaged me or somebody called me saying that from tomorrow morning demonetization is happening, etc. And I told my wife I have to go to office. So you may not remember it, but I remember that 3 months very, very clearly. And then some of us got together in one of the conference rooms upstairs on the 8th floor, trying to figure out what is it that we need to do tomorrow. There was no playbook around this, right? And so therefore we had to create a playbook on what exactly we needed to do. It was dramatic. I mean, you were in a situation where 1.4 billion people did not have access to their cash the next morning. I don't think what you also saw was from the government. You saw various changes in rules and regulations. They were also making this up as things evolved across the country. Branch heads, we did not know what exactly needed to be done. I think if I remember right, they people had time till for 3 months for them to exchange their notes, but obviously every day the lines got bigger and bigger. Branch heads had to think this through on the fly. There were customers, there were non-customers, there were these limits, then those limits changed. New regulations came. Somebody said, hey, if I have a wedding, if I produce a wedding card, then I should be allowed to take little more money, or something like that. So stuff like this kept evolving literally on a daily basis. Then obviously the media, the newspapers, etc., had a field day around this. There were long lines across the country, outside branches, outside ATMs. Bankers were doing whatever they could to be able to sort of manage the situation. But we had situations where they would in various parts of the country, people have stood in line for hours, and have actually died in that heat, etc. And so therefore it was certainly a very, very trying time in that sense. Then there was this whole concept of old notes, new notes, reconciling those old notes, new notes. Then obviously India being India, there were various types of jugaad that was happening, and therefore as bankers we needed to there was no playbook. I mean, so therefore we needed to evolve around this, and manage. And I think branches were basically working for a period of about 3 odd months. We were working on a 24/7 basis. We actually also created a specific call center for the branches at this point in time, because there were hundreds and hundreds of queries that that customers came up with, where we in many cases did not have answers, or we were trying to figure it out. There were regulations that were being issued by the government. There were regulations being issued by the bank, by RBI, and we needed to get all this right. So it was a very, very, trying time as a retail bank. But I think across, and it's not just Axis Bank, but across the banking system, I think the way that the banking system coped with this during that period, many banks, created chamianas outside their branches, created seating for, customers, ensured that there was adequate water and such like, um, served both customers, non-customers in as efficient a manner as possible, created paper trails wherever required. Um, and I think there was a lot of learning, and I think this was the classic VUCA movement where you really did not know, what the situation would be the next day. Not just in terms of, you knew that the number of people outside the branch were going to be at least as much as you saw yesterday, but the rules and regulations around this were going to be quite different. And what those and you had no idea what that rules and regulations will be the next day. So therefore, it was, I must say that that was perhaps the most traumatic part of my career, and being able to manage internally, being able to manage the external environment, the noise that we saw around this was quite stressful.
Yep. I move on to Rajiv, the next one, which is soon after, or not soon after, but a few years after, you moved on to take charge of the corporate bank in a new role. And this is kind of the dark period for Indian corporate banking, right? The NPA crisis and so on and so forth. So just talk us through what happened, what learnings, what infrastructure got built, how's that helping?
By the time I had moved, we had moved away from, we have moved to a situation of recognition, and we were beginning to move into a environment of resolution. And so therefore, to that extent, much of the problems of the NPAs of 2015 to 18, let us say, was behind us by the time I moved to the wholesale bank. My job was really to rejuvenate the wholesale bank, to become, most wholesale banks were struggling at that point in time because of the fact that you're beginning to recognize all the bad loans. The size of the provisioning that you were doing on a quarter-on-quarter basis was quite high, wiping out a significant part of banks' profitability, etc. And so therefore, being able to move from that environment to be able to build a long-term, predictable, profitable corporate bank was really the job that I thought I had. From a corporate bank perspective, obviously morale was low. So therefore, one of the things that you needed to do is to ensure the kind of culture that we had, from a more long-term infrastructure finance bank to a more working capital, granular business, which needed to be built. We needed to bring in some new people. We needed to change the underwriting standards that we had. We needed to, while you move away from infrastructure to more working capital, yields are lower. So therefore, you needed to build out other lines of business as well. You will get some part of that business because of the fact that you are a balance sheet lender, but the rest you needed skill capability, solutioning capabilities, and so therefore you need to bring new people in. That's really what we did over the last 4-5 years of moving from being at least on a segmental basis, where the business was, because of the provisioning, was actually losing money, to become a significant revenue generator for the bank. I think it is also important for us to mention two things. One is the evolution of the IBC process, and I think what you can see here is an enduring theme of building of infrastructure, helping banks build businesses into the future. And IBC is one more of that. And I think while today one can complain about the way that IBC has actually played out, in terms of the delays, in terms of some of the sort of regulatory constraints that have played out. But I think fundamentally it has certainly changed the relationship between the large borrower and lenders. I think the IBC process has demonstrated to promoters in India that through the process you could actually lose some of your prized assets. And so therefore I think two things have happened with the promoter. One is the behavior has gotten cleaned up, and two is I think the risk taking ability of promoters in India has reduced as well. And I think in that same context, what we've seen is, except for the brief period during COVID, actually corporate profitability, corporates used their free cash flows to pay down debt. Therefore free cash flow actually improved. They deleveraged, and actually are in a situation where their balance sheets are strong and very, very strong, and are able to take on much more debt than they have today, to be able to grow into the future. From a long term perspective, that's very good. But the question to ask is, why are they not doing this? Is this because the IBC process has somewhat scarred the risk taking ability of the promoter, or are they uncertain about the future? I think that is a question that is worth asking. But I think fundamentally the IBC process has certainly changed the behavior of, or the relationship between the sort of the borrower and lender, and that is I think certainly something that has helped reduce. I mean, we've been in a benign corporate environment now for almost the last 5 or 6 years, and I see because of the fact that it continued to be deleveraged, I don't see that changing anytime in the future.
Right. So Rajiv, we've covered like a long spectrum, and just to put this in perspective, in the 90s we have everything physically done. It takes 7 days to buy or sell a share. CRR is managed on paper. There is no computers. Everything is happening manually. And then kind of one crisis happens and lots of infrastructure gets built. SEBI, NSE, Dematerialization, setting up the custodians, etc., stock clearing companies, and so on and so forth. And then the markets kind of start to kind of do what they do. Similarly, 2008-9, we have a big retail crisis. Lots of NBFC shut shop. But then bureaus get built. We have the likes of Aadhaar, etc., come in. We have digital rails come in, and then we see 10 years of great credit growth. We see retail banking, move from this people going to the bank branches to update their passbooks to now being able to transfer money instantly. And we didn't speak about this, but at no expense. That's the other one, right?
Yeah, absolutely.
Whereas if you kind of earlier, obviously it was expensive, and if you go to any other country in the world, you will pay something, 1%, 2% to just transfer money, but here you don't. And we've seen hence what's happened to retail payments and, people moving away from cash to digital payments, etc. And in the last one, we spoke about how on corporate banking, because of IBC and a few things like, KRILC, another one, right? Like that RBI has built, where it's kind of like the bureau where you can go and see what's the exposure that a corporate has and whether they've defaulted, and some other regulations, etc., which is now created a strong base for potentially the corporate sector also to grow quite dramatically. So great journey. Now, Rajiv, as you think about this entire thing, one thing that kind of strikes me is just the progress we made in the last 30 years.
Amazing.
And 30 years it's a long time, but actually it's not that longer time as well, right? So we made some dramatic progress. And the point you made that in the day-to-day, it feels like, frankly, we always have this missed timelines, and we do reviews and say this is delayed, that is delayed, etc. But when you take a step back view, actually the progress we made is
Tremendous.
Is quite tremendous.
Just want to put one more thing in perspective. The Tokyo Stock Exchange closed. The New York Stock Exchange is closed during this period for various reasons. Bombay, the National Stock Exchange, the Bombay Stock Exchange, are never closed. Even after the bomb blast, they were open the next day.
Right.
And I think that is phenomenal. And I think just shows you the resilience of the financial system in this country. We've had various crises, etc., but the financial systems have never, come to a halt, which is, I think, is truly amazing.
No, absolutely. So Rajiv, now as you sit here, what are your 2-3 hopes, predictions, bets for the next, let's say, 5 or 10 years?
I think I'm fairly certain that the way that we are doing business today will not exist 5 or 10 years from today. In the same manner that you no longer needed to go to a branch to update your passbook, I don't think you will. I think the evolution in terms of AI and machine learning, etc., is going to completely disrupt the way we think about our business. It's still very, very early days, but what I'm certain is the way that we are doing business today will not. It's not going to be. It's not going to be different. It's going to not exist. The business will remain the same. I mean, banks have been doing lending and borrowing for 500 years. I don't think that changes, but how we're going to deliver that to clients is I think is going to fundamentally change. I think we've made huge progress in terms of financial inclusion, etc. But I think there's a lot that we need to do. We need to continue to do as we go forward, as our ambitions for the country will change. And the other one, which also I'm very confident is that the next 10 years will, from a banking perspective, will belong to the MSME lending space. I think that piece is going to get bigger and bigger, and is going to sort of drive profitability for banks over the next 5 to 10 years.
Fantastic. And Rajiv, if you had one piece of advice to people who are watching this from your career, what would that be?
Lamba socho. I think careers, lives are a marathon, not a 100-meter dash. And so therefore, you will get the full benefits of your career, your life, if you think long term.
Fantastic, Rajiv. Rajiv, thanks a lot. With that, we come to the end of this episode. It was fantastic talking about this 30-year journey. And as you said, you are the poster child of liberalization. And from our team and the bank and from me, all the best.
Thank you so much, Amir. Thank you for having me. Really delighted to have had this conversation.
Thank you.
Thank you.
Thank you for listening into this episode of Open Dialogue. I hope you enjoyed this as much as we've enjoyed bringing it to you. We are overwhelmed by the response that we've received and really look forward to your comments and feedback. Do like and subscribe to our channel to keep track of new episodes that are coming through. Thank you.